right. Our next guest doesn't think the 10-year yield will head much higher from current levels. Subhadra Rajappa is the head of U.S. rate strategy for Societe Generale. Great to have you with us, Subhadra. So by end of the year, you don't expect 5%. How about for 2025?
Unlikely.
Okay.
Because I think that what we're going to be focused on, at least for the early part of the year, is tariffs and immigration and the inflationary impact of that. So if the Fed keeps policy on hold for a lot longer or doesn't deliver as many cuts, then what you're going to see is perhaps even a rally in the long end of the yield curve, because tariffs could be inflationary, and in some respects, if you look at that as a tax on consumers, you could see that being translating into lower growth and lower yields in the back end. So it might seem like a contrarian view, but there's definitely a case to be made that the yield curve could actually even flatten from here.
Mm-hmm. Implicit in that forecast, though, is the assumption that the Fed will adjust policy according to what is done by the president, what is done legislatively, and that there is that sort of reaction when so many people have said, tariffs are a one-off, they're going to look through that. You don't agree. They will adjust according to what is going on around them?
Yeah, I mean, I think it is a one-off in the sense that you're going to see a step up in prices on the items that are being tariffed. It's not something that's going to have a multi-year impact. But that said, I think that, the Fed doesn't have enough clarity on what's to come next year. So they're going to wait and see how things progress and then act accordingly. So you're going to see a little bit of a lag, and that's why I think in some respects, if you look at the summary of economic projections, I'm not sure how much real information there is going to be in tomorrow's update, because they don't really know a lot about what's coming up on the policy side.
So let me ask you, how much invisible pressure is there on the Fed to cut to cut Fed funds rates, because so much of the deficit is funded by these shorter term rates?
Probably very little. I mean, the Fed and the Treasury work, separately. And the Fed, of course, has a dual mandate. They're going to be concerned about inflation as well as employment. The Treasury is the one that decides how they're going to issue. The Janet Yellen Treasury has favored more bills and hasn't really termed out the debt. We've heard from Besant that he might be more amenable to terming out the debt. But the concern, as you were talking about earlier, is that if you do see an increase in long end coupon supply, that you could see that long end start to rise. You could see that term premium start to build up on the yield curve. You really don't want Treasury yields going to 5-6% in short order. I mean, if it goes up gradually from here, it's one thing. But if there's sort of markets are spooked and you see this sort of sell-off at the long end because of more issuance, that's something that I think you're going to have an impact on risky assets, and you're going to see a tightening of financial conditions.
So in that context, Subhadra, when I think about U.S. rates, at times we've been somewhat a function of what's been going on globally. I was of the view that the BOJ was going to be in some way indirectly a driver of U.S. rates. In other words, if rates in Japan go higher, I think rates in the U.S. have to go higher. Any thoughts on this? Because, again, central bank policy also is becoming somewhat divergent. I mean, Canada, their inflation rate slipped below the central bank's target. You can make an argument the ECB is going to be cutting more aggressively than the U.S. Central banks around the world are not aligned anymore, and that will affect rates.
Yeah, and you are going to see these divergences between all the different countries' bonds. For instance, right now, if you look at what 10-year treasuries are versus 10-year bonds, you're seeing that spread widen out quite meaningfully because the market's priced in a lot more cuts for the ECB versus the Fed. It's the same with the BOJ, but the interesting thing about the BOJ is that the more they hike rates, the more, less the demand for treasuries, because a lot of these domestic buyers are going to be buying JGBs as opposed to buying treasuries. So the demand dynamic really changes. Again, that could be something that could put some pressure on term premium, because we do rely on foreign demand for treasuries to keep treasury yields lower.
Right. Specifically for the Fed, what is the one thing you'll be looking for, either in the CEP or in the press conference, or any sort of, what is the one data point or what is the one question that you would want answered?
I'd like to see what their projections are for inflation for next year and how they square the circle on how many cuts they have penciled in. I mean, again, there's probably not going to be a lot of informational value because they don't know how things are going to play out next year. But that said, I think that at least gives you an initial read to recalibrate. I mean, let's say they go from 4 cuts for next year, which is what they had in the summer, in September, to 2. That leads me to believe that they're much more amenable to keep policy on hold, perhaps for a lot longer. Our personal view is that they go from 4 to 3 because it's much more gradual. They probably don't want to be seen as moving the dots too much. But that's something that I think would be more of an indication to the markets on where they're thinking on inflation and how they're likely to react if inflation is actually sticky.